I'm having trouble believing that today is Thursday, December 1st.
December 1st.
Wow.
Happy holidays. Merry Christmas. Happy Hanukkah coming up.
To everyone. Well, any surprises yesterday from Jerome Powell's view on interest rate increases in the near future?
I'm going to show you one. I'm scratching my head on something.
Yeah?
Head scratch.
Why the Dow went up 700 points?
700 points. Jerome Powell yesterday gave us three specific things. He says there's still a long way to go, one. He said rates are going to go up, two. And he then said he's going to stay the course, three. And what'd the market do?
The market just whistled through the graveyard.
Yeah, let's open champagne bottles.
Yeah, absolutely.
And so the market focused on the words moderate pace.
Yeah. You know, with what's coming down the pike, what we know is coming down the pike is going to be higher unemployment. I mean, we talked about it on today's show, what the furniture company that affected so many people in the Triad area, Lexington and other areas, just shutting down without giving any warning or allowing them to have COBRA or any kind of severance.
CNN,
and
just
and so the election,
people.
The midterms are over, and now you're going to start to see more and more unemployment numbers. And anytime the Fed's expecting unemployment to go from 3.5% to 6.5%, that's a whole lot of people.
Yes.
When you look at that from a percentage basis. So that's never good news, and that just means fewer people will be buying things, fewer people will be generating taxes for our economy. It's not going to be 2023 first half is not going to be pretty.
A report that we read this week and we talked about on the show summarized where we are right now. Rallies happen in bear markets. So we aren't surprised. Don't be surprised.
Right.
When rallies happen in bear markets, it's a good time to reevaluate what's in there. Let's hang on to what we have, maybe add a little bit to it, and or let's get rid of what we don't like. And that's what we've been doing.
And too many people do ready, shoot, aim,
right.
When we start to see these things. In other words, they jump in too early and then they get burned on the downside. And I do think, and you do too, that we're going to see some more downside, especially in the first half of 2020.
And that brought us to the third thing the article said. It is good and okay at this point in time to have cash or cash equivalent. And that's what we're doing. We're holding cash. We're buying treasuries. We had money come due in early November in a lot of accounts. We bought another 3-month treasury. We're getting good, solid rates of return. We're being cautious at this point in time. And as you said on the radio, there are things coming that we're going to realize are going to be bumping the road. But with that being said, there is going to be a time, and I'm going to go on the show right now.
You're going on record?
I'm on record. I would not be surprised if by the end of the first quarter, going into the second quarter, we are not talking about it's time to begin to buy back into the market.
I think that's a very relevant time frame.
I'm going to give one other thing. I would not be surprised if by the end of next year, whereas we're under, on average, we're about 40 to 45% in equities, and the rest of it is cash and defensive positions. I would not be surprised if by end of next year we aren't at least 50-50.
Yes, and I would say maybe even a little higher than that.
So
we know what we're going to buy,
and we know when we're going to do it. We're just looking for the right time. Let's let the sale price get a little bit more. Let's enjoy the holidays coming up, and take time to reach out and hug somebody and tell them you love them. But we love you, and we're glad you're our clients, and we're glad you're with us, and we're glad to meet new people.
And don't forget, it is your money.
And your money matters.